stocks and bring in Mike Lee, who joins us now. We are moving higher today. Again, it's all been the volume of trading, of course, light on this holiday week. But Mike, I guess my question to you, and good morning, do you think the rally can last, or are we setting ourselves up for another leg down before the end of the year?
You know, seasonality trading historically pushes you higher in towards the end of the year, especially after a midterm election. So we could definitely see a few percentage points higher. But regardless of the recent strength in the market, you can't escape the inevitable. And the inevitable is fourth quarter earnings at the end of June, the estimate was for 9.1% growth. Now the estimate's for a 2.1% decline. That's over a 10% correction. Earnings estimates for 2023 are most likely way too high. Housing is in a massive downtrend. Manufacturing, same downtrend. 2/3 of global PMIs are in contraction 3 of the last 4 months. The ISM new orders have been in contraction in the U.S. So there's a lot of problems here, and I think the Fed is likely to be more aggressive than less aggressive. I think they're likely to go for longer than shorter, because as the economy heads into recession next year, which I believe it will, the tools for the Fed to tighten become more limited. So if they don't really kill inflation now, they're going to have a very difficult time doing it later. So I don't know that this necessarily means stocks are going to correct 20 or 30%. I just think it's going to be hard for stocks to break out to new highs until inflation's under control and until the economy can these downward trends start to either flatten or reverse themselves.
Right. Well, and given all the headwinds that you just listed, Mike, and again, to emphasize the point you've been making, do you think the earnings estimates are too high? I mean, is it a bit Pollyanna given everything that we're facing?
Yeah, so I think that's going to be the story as we come into January, is earnings estimates continuing to come lower and lower and lower. And I'd say these markets pushing higher is going to give more credence to the Fed theory that there's too much liquidity out there and the money supply is too big. There's a lot of money and a lot of cash on the sidelines that the Fed needs to remove to finally kill inflation and get it back down to their 2% target. So look, I don't necessarily think it's Armageddon. I just think I would be cautious right now. And if you had some tech stocks that are really rallying hard and you've made a lot of money the last couple of months, you don't need to go all the cash, but take 5 or 10 or 15% off the table if you didn't like the motion in the ocean this year, and hopefully you get a chance to buy back cheaper next spring.
But very quickly, Mike, if we do see another leg down, to your point, could there be some bargains in there? Is it time to have a little nibble?
Oh, absolutely. This year has been the year where stocks take the escalator up, and the saying goes, the elevator down. It's more like bungee jumping down. So with any sharp sell-off, I'd be looking at your favorite stocks, the Googles, the Microsofts, the Apples, the high-quality companies that aren't going anywhere, that are most likely to come back even stronger through the next business cycle.
Very good. We got a lot in. Mike Lee, great stuff. Thanks for joining us.
Thanks, Ashley.